Hi, let's work through the meaning of capital gain and capital loss as a real estate investment terminology to know. Investment real estate terminology. Real estate licensees will be asked by potential investors for guidance in choosing investment property. To work with investors, licensees need a good understanding of how to measure the financial performance of investment property. With residential property, you will find investors that are looking to either rent the property or do a fix and flip. On the selling side of a fix and flip, especially in the retail market, there's already room calculated in the selling price by the investor for your commission. Their objective is in getting the property sold as quickly as possible so that they can fund the next project. These investors will want a market knowledgeable real estate agent with great marketing reach. One of the exciting aspects about being adept at working with investors is that these individuals will usually keep coming back to you to purchase or sell more properties. However, just as the potential rewards have increased to you, so has the potential for liability. Working with aggressive investors on both ends of the deal, locating and buying properties, as well as the listing and sale of the improved property. To prepare to work in this specialty, start by understanding basic investment terminology. Capital gain or loss. Every property owner who sells property must report to the Internal Revenue Service whether a capital gain or loss resulted from the sale. Capital gain is calculated by taking the sale price minus expenses to sell minus the adjusted basis of the property. If this is a positive amount, then it is a profit. If it is a negative amount, then it is a loss. Sale price minus selling expenses minus adjusted basis equals capital gain. Note: in practice, the adjusted basis may be reduced by property depreciation already reported during taxable years. Capital gain or loss story problem. Lonnie sold an investment property after holding it for several years. He sold it for $310,000 and paid $24,600 in selling expenses. His adjusted basis for the property is $260,667. What is the amount of his capital gain or loss? Solution. Solution. What is the amount of its capital gain or loss? First, you take the sale price minus the selling expenses and then subtract the adjusted basis to equal the capital gain. So in this case, we have a $310,000 sale price minus $24,600 in selling expenses minus $260,667 as the adjusted basis equals $24,733 as capital gain. And it's a gain because it's a positive amount. Don't overpay capital gains tax. When property is sold, the profit from the sale may be subject to capital gains tax. No one wants to pay too much in taxes. By failing to adjust the original cost of the property by capital improvements, this could result in an overpayment in capital gains tax. Even non-investors may face a capital gains tax on a personal residence for property when it is sold. For example, Sally Jones bought a property in 1972 for $115,000. It cost her $4,600 to purchase. She sold the same property in 2012 for $425,000. Her cost to sell was $38,000. Based on her original purchase, she would owe capital gains tax since upon the sale she profited more than $250,000. The $425,000 as the sale price minus $115,000, which was the purchase price that she paid in 1972, minus the $4,600, which was the cost to purchase in 1972, minus the $38,000 that it cost her to sell the property in 2012, equaling $267,400 as a profit. Based on capital gains rules, she is exempt from capital gains tax only if her profit is at or less than $250,000. However, in 1984, she had spent $55,000 to put an addition on her house. She had not taken any depreciation on her taxes. By subtracting for the addition that Sally had added to the house, she would not owe tax for a capital gain. $260,000 minus $55,000 equals $212,000. No one wants to lose money on an investment. Unfortunately, even in the best planned situations, it does happen. When it does, the capital losses may be claimed on the party's tax return. All property owners should keep clear, accurate, and complete records to claim these losses. Keep in mind that real estate licensees are not to advise investors on tax issues and should always direct clients to consult with tax professionals. No one wants to lose money on an investment. Unfortunately, even in the best planned situations, it does happen. When it does, the capital losses may be claimed on the party's tax return. All property owners should keep clear, accurate, and complete records to claim these losses. Keep in mind that real estate licensees are not to advise investors on tax issues and should always direct clients to consult with tax professionals.